Sam wanted passive income, but the idea of buying and managing rental property never appealed to him. Real estate takes capital, maintenance, and time most people don't have lying around. Luckily, real estate isn't the only way to build assets that pay you every single month. Here are 5 that don't require buying a single property. Asset 1. Monthly dividend stocks and ETFs. Most companies pay dividends quarterly, but some pay monthly instead. That monthly rhythm can line up naturally with monthly bills, rather than waiting 3 months between checks. Sam researched a handful of established companies known specifically for consistent monthly dividend payments. Asset 2. Bond funds and Treasury ETFs. Bonds are loans to governments or companies that pay you interest over time. Many bond funds pool these payments and distribute them to investors monthly, rather than semi-annually like individual bonds. Sam liked that Treasury-focused funds carried lower risk, even if the returns were more modest. Asset 3. Certificates of deposit and high-yield savings accounts. Not glamorous, but genuinely useful. These pay interest monthly, are federally insured up to standard limits, and require zero ongoing management. Sam used one specifically for his emergency fund, letting it quietly earn interest every month. Asset 4. Business development companies, often called BDCs. These lend money to small and mid-sized private businesses. In exchange, they often distribute a large share of that lending income to shareholders monthly. BDCs tend to carry more risk than Treasury funds, since they're tied to how those businesses perform. Asset 5. Covered call and option income ETFs. These generate income by selling options contracts on stocks they hold. That premium income gets collected regularly and often distributed to investors on a monthly schedule. These funds can trade some long-term growth potential in exchange for that steady monthly income. Sam built a small basket across all 5, rather than putting everything into just one. None of these are risk-free. Every one of them can lose value, and yields can change over time. Higher yields often come with higher risk, an idea worth remembering before chasing the biggest number. Some monthly paying assets, especially BDCs and option income funds, can also be more volatile than plain index funds. Sam started small, treating this as one part of a diversified plan rather than a shortcut to freedom. He reinvested the monthly payments at first, letting them compound before ever taking a single payout personally. A single small amount doesn't feel dramatic at the start. Steady monthly deposits compounding is a slower story. Over time, watching those small monthly deposits land became its own quiet kind of motivation. None of these require tenants, repairs, or property taxes. That trade-off matters to some investors more than others. They also don't build equity in a physical asset, the way real estate can over decades. Every income strategy involves trade-offs between liquidity, risk, effort, and growth potential. This content is educational, not personalized investment advice. Markets carry risk, including loss of principal. Consider speaking with a financial professional about which any of these fit your own goals and risk tolerance. Sam didn't quit his job. He simply added another small, steady stream running quietly in the background. A year in, the monthly deposits were still small, but they were real, and they were growing. You don't need a rental property to start building assets that pay you regularly. You need research, patience, and a willingness to start small and let time do the rest.